All right, what's up, everyone? It is January 16th, 2026. Today, we're talking about DexFi, which is in a bit of a consolidation mode after that killer all-time high. So let's break down exactly what's going on. But first, you know the drill. This is all for educational purposes. It is absolutely not financial advice. Always do your own research. Okay, let's just get right into it. The fund is sitting around $1.87 million. That's a 5.6% pullback from the all-time high we just hit back on January 14th. And look, seeing a number like that can definitely raise some eyebrows. Which, of course, leads to the one big question that's probably on your mind. Is this it? Did we just hit the top? I mean, it's the first thing we all think when we see a dip right after a huge run-up. But here's the thing. This should feel like déjà vu. Seriously, because we have seen this exact pattern play out just about a week ago. The key today isn't the dip itself, but the pattern that it's following. So that brings us to the main event for today. We're going to see how history is rhyming. Let's compare what's happening right now to what happened just a few days ago. Okay, so here we've got the two most recent consolidation cycles side by side. On the left, you've got January 6th to the 9th, and on the right, that's us, right now. Just look at those percentages. Notice anything similar? They're nearly identical. And when you look at the actual hard numbers, the consistency is, well, it's remarkable. The first cycle, it saw a 5.3% correction after its all-time high. Our current one, we're in a 5.6% correction. And remember what happened after that first one? A full recovery. And then we pushed to a brand new all-time high. So what we're seeing here isn't a red flag. It's not a sign of collapse. This is textbook consolidation. After a really powerful rally, the market just needs to take a breath, find a new floor, and build a base for the next move up. This is healthy. It's expected. Now, let's see how this little dip fits into the bigger picture. It is so easy to get caught up in the day-to-day noise, so let's zoom out and look at the fund's journey over the last 37 days. This timeline really tells the story. We started at 1.62 million, had that low on Christmas, and then just rallied. Then we had that first correction and recovery, and then bam, we set another higher all-time high. The pattern is crystal clear, higher highs and higher lows. And get this, despite this little pullback, the fund is still up a very solid 15% over the last 37 days. That's a total gain of over $244,000. The underlying trend is still incredibly strong. And if we look from that Christmas low, the performance is even more impressive. We're talking a 19.5% gain. That's just over $305,000. So this context is crucial. We are consolidating our gains, not giving them back. Okay, so the chart pattern looks familiar. We've established that. But what about the engine? Let's pop the hood and check on the protocol's actual health metrics. So what's driving this move? Well, the main driver is pretty clear. It's ETH. Since the fund's all-time high, ETH has pulled back about 2.7%. The fund, with all its LP positions, has moved about twice that, dipping 5.6%. This correlation is totally expected. Once ETH finds its footing, the fund should follow right along. Now, what about volume? Today, it's at about 7.05 million. Yeah, it's cooled off a bit from the peak, but that's normal. And what's great is that the volume is really nicely diversified across a bunch of protocols. No single asset is hogging the spotlight, which is a fantastic sign of a healthy ecosystem. Next up is capital deployment. This is a huge indicator of confidence and activity in the protocol. And right now, the rate is at an impressive 93.38%. But here's the best part. That rate has actually improved during this dip. The wallet size has shrunk, which means that capital isn't just sitting on the sidelines being scared. Nope, it's being actively put to work in the vaults during this consolidation. That is a very bullish signal. And what about for all you bondholders out there? Well, as the fund value dipped just a tiny bit, the APR has ticked up to a very, very healthy 27.35%. Yep, that's an increase from 25.5% just a couple of days ago. So what does that mean? It means holding through this little consolidation period has actually become even more attractive. You're getting a higher yield. So we've looked at the price pattern, we've zoomed out on the long-term trend, and we've checked the internal health metrics. Let's put it all together and figure out what it all means. After digging through all this data, what's the big takeaway? Where are we at right now?
Our verdict is simple. This is a healthy consolidation. We're calling it yellow-green. A little bit of yellow for caution because, yeah, it's a pullback. But it's overwhelmingly green because all the underlying metrics are strong and the pattern is so productive.
Let's just sum it all up. The pros are huge. We're still up 15% in 37 days, the deployment rate is up, the APR is up, and we're holding a higher low. The only real con is the 5.6% dip from the absolute peak, which, as we've seen, is just part of a recurring healthy pattern. So the final thought here is pretty simple. Patterns repeat. That January 6th correction led to a full recovery and a new all-time high. We're just seeing the same playbook run again. If history rhymes, that recovery is coming. And in DeFi, patience really pays off.
Thanks for tuning into this explainer. And one last time for the road. This was for educational purposes only, not financial advice. Do your own research before making any decisions. We'll catch you on the next one.